Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
There's really no way around it. Tesla's third quarter earnings result was really terrible. The conference call was arguably worse. The stock was down over 9% in trading on Thursday. As I'm recording, we've had about 24 hours to process exactly what this quarter looked like, what management said, and I just don't think there's many positive takeaways. So I want to get to a few of the things that I took away from the call, how this was really a continuation of trends that we've seen at Tesla for over a year now, and why I don't think conditions are going to get better anytime soon. My name's Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And I want to start first with Tesla's report and some of the numbers, and then I'll give some background on some of these in just a second. This is the financial summary. This has a lot of the information about what's going on in the business. The biggest takeaways here: automotive revenue up just 5% year over year, actually fell pretty significantly quarter over quarter. And then this is the big one: gross profit down 22% from a year ago, operating income down 52%, and go all the way down here, almost to the bottom, free cash flow down 74%. Now, this was supposed to be a high margin auto company. That was what Tesla has always been billed as. It's also supposed to be a high growth company. So what we're seeing right now is that Tesla is not growing and margins are getting worse. Actually, margins right now are worse than they are for Toyota. They're approaching what General Motors and Ford generate from a gross margin and operating margin perspective. So it's hard to argue that this is a good quarter at all for Tesla. And I want to put these numbers into some historic context because this has been coming for quite a while. The first thing I'm going to show is production and deliveries. You can see that over the past year, since Q4 2022, production is actually down. This is a year over year number here on the right, 18%. But since Q4, production was 440,000 units in Q4, 430,000 units in the most recent quarter. Deliveries are up, and that's because Tesla's no longer building inventory, which they were doing for this entire 1 year period. But that production number is really important because this gets to the company's pricing power or lack of pricing power. This first chart is the revenue per vehicle for Tesla. And the way that I got this is simply automotive revenue excluding credits divided by the number of vehicles that were delivered each quarter. The peak in revenue per vehicle was $57,331 in the second quarter of 2022. That has declined over $12,000 to $45,109 in the most recent quarter. So production is actually down slightly and prices are down. Volumes are not going up, and Tesla's had to reduce prices. Now, one of the reasons this is notable is they did exactly the opposite during the pandemic. Remember when automakers couldn't make vehicles because there was the chip shortage? Tesla was the one company that was able to keep growing their production, but they had so much demand that they actually raised their prices. Revenue per vehicle in Q1 2021 was $48,712. That increased almost $9,000 by the time the second quarter of 2022 came out. That was when we were at the peak of this mass shortage of vehicles, but that has subsided, and all other automakers are seeing growth in their production and their margins and their profitability. Tesla is seeing the exact opposite. Now let's get to the margin profile. I'm going to start with a chart that hopefully puts some context to these margins, because one of the things that I hear a lot of is that Tesla is reducing the cost of their vehicles really rapidly. That just isn't backed up by the numbers. You can see in this chart that production costs are about similar to what they were 2 years ago. There's going to be ebbs and flows in this based on commodity costs, based on production per quarter, but fundamentally, we don't see a dramatic reduction in cost per vehicle, especially not one that justifies the reduction in prices. So as a result, you see profitability per vehicle dropping like a rock. In the first quarter of 2022, gross profit per vehicle was $15,675. So nearly $16,000. In the most recent quarter, that profit per vehicle had dropped to $7,158, dropped by over 50%. That's the profit per vehicle. If you are a manufacturing company, which Tesla is, what you want to do is you want to make the most amount of money per vehicle balanced with the number of vehicles you're making. If you are increasing your production 50% per year and you have to give up on price, you can't make that up in volume if you keep cutting your prices and you keep cutting your margins. That's why we're seeing margins overall on the decline. This chart shows that margin profile over the last couple of years. You can see that margins peaked at 28.8%. That was in Q1 2022, now down to 15.9%. This is excluding those credits, but the trend is extremely clear. Tesla started cutting their prices in the fourth quarter of 2022. That was when we started to see those discounts that were going into effect. Those discounts have increased throughout 2023, and that's why margins continue to go down. So put all of this together. We have flat production, but prices are going down. That indicates that supply exceeds demand. This is just the simple laws of supply and demand. This is Econ 101. And what is Tesla doing? They're increasing production. They've actually pushed back some of those increases in production. So I think that is interesting because it puts some of that growth narrative into question. But the profitability isn't going to get better as they're increasing their production. So if they do, in fact, increase production of the 4 models that they have now and introduce the Cybertruck later this year, we could see these margins continue to slide. Speaking of the Cybertruck, a lot of the discussion on the conference call was about how difficult the ramp of the Cybertruck was going to be. This is a very different vehicle design from anything that we've seen before. Musk has talked about that. They've talked about what a difficult design process and manufacturing process this has been, that it's going to take at least 18 months to get to free cash flow positive. So we know that this is going to be a difficult ramp. But I think the backdrop of the current environment is something we need to think about. So Tesla's demand for their existing vehicles is going down. Now they're introducing this other new vehicle, which is more like a pickup truck, competing with things like the F-150, Chevy Silverado. So what have we seen in those markets? Well, we've seen Rivian doesn't have the demand for the pickup truck, the R1T, that they thought they would. You can now get an R1T within a couple of weeks. They don't really have a backlog for that vehicle. We heard this week that GM is pushing back expanding production of their truck. Ford is cutting back production of the F-150 Lightning. Demand for electric trucks just doesn't seem to be there. And now Tesla is saying they're going to produce around 125,000 next year and as many as 250,000 a year or two after that. So it's going to be a difficult ramp, and they're going to increase supply of their vehicles. Now, management has reiterated over and over again that they have over 1 million deposits, but the deposit is relatively small and it's refundable. Tesla's deposit was about 10 times as large, and a lot of people ask for those deposits back. So depending on what the price looks like, which we still don't have a definitive answer on, I think this could be not only the most difficult ramp that Tesla has ever had, but it could be the first product that really underperforms expectations and makes these problems, these margin problems, even worse for the company. The other big thing that came out of the conference call was Elon Musk's comments about full self-driving, or FSD. And the most telling part came about with a question that was related to Mercedes level 3 autonomy, where they are taking responsibility or liability for the autonomous driving system. There are 5 different autonomous driving levels. Tesla's FSD falls in what we call level 2, where the liability ultimately falls on the driver, not on Tesla if there's some sort of accident. Level 3, that liability shifts to the automaker. That's the biggest difference between level 2 and level 3. Level 4, you get to a fully autonomous vehicle. You don't have to have a driver, but it's geofenced. That's what we see with Waymo, Cruise, Zoox. There's a number of companies who are already operating and starting to operate at scale in level 4. What Tesla is shooting for is level 5 autonomy. So what this person was asking was, when are we going to even get to level 3, much less level 5? And Musk's answer, I thought, was really troubling because he kind of goes on this rant about how Mercedes' system is not all that impressive. Jokes about how people think that the liability is already Tesla's. He actually said later in the call that the liability was Tesla's. So we'll kind of look past that because that was an odd comment. And then he talks about how it only works in certain roads in Nevada and California, can only operate under 40 miles an hour. And that was the end of the question. The question was not answered. When is Tesla going to get to level 3, much less level 5? We're not even talking about that. Just level 3, where they take liability for FSD, full self-driving as it is called. And Musk didn't answer the question. So if you think that Tesla is going to be ultimately an artificial intelligence company and a full self-driving company and build robo taxis, you have to take the step to get to at least level 3, and more realistically, you need to get to level 5 autonomy. Musk has been talking about that for years, but it has not happened. And right now, we're seeing multiple companies launch vehicles that are level 4 autonomy. Those robo taxis that Tesla has been talking about for years are actually on the road today. You can get in a Cruise, get in a Waymo vehicle today. So you add all of this up, and I think it's very troubling for Tesla. This is a company that still has a valuation of $770 million. The stock would have to fall over 90% to be on par with their competitors. But now we're seeing that margins are already on par with their competitors. They've fallen that far. Some of these up and coming projects like the Cybertruck, like FSD, maybe aren't going to have the impact that a lot of investors think. So what are you left with? You're left with a fairly slow growing company with deteriorating margins and a very uncertain future in new products like the Cybertruck, FSD, Robotaxi. We've been hearing about that for years. Optimus, Dojo, all of these things are unknowns. And I think the valuation for Tesla today, this has always been my criticism of the stock, is just completely out of line with the performance of the company. Those extremely high margins that we saw during the pandemic appear to be a one-time event. And now that we've gotten back to more normal operations, we're seeing that either margins are going to come down as production grows or production growth is going to stall. So as an investor, you have to ask, what do you want? Do you want better margins but a slower growing company, or do you want a faster growing company and lower margins? Either way, I think the valuation has to come down to make any sense for investors. So really tough quarter for Tesla. I think the conference call, if you haven't listened to the conference call, that is worth doing. I'll put a link to that in the show notes, but it was really, I think, a very negative call, and that seems to be the consensus with a lot of investors. But what did you think about Tesla's quarter? Let me know in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.